Hey there, and welcome to the channel. If you're new here on this channel, we explore smart investment strategies to grow your wealth and achieve financial freedom. Today, I'm excited to walk you through a new breed of ETFs that I am using in my portfolio to generate weekly income. The 0DTE covered call ETFs, QDTE, XDTE, and RDTE. As always, the information presented in this video is for educational purposes and should not be considered financial advice. Be sure to evaluate how these securities align with your financial needs and consult with a professional if needed. Okay, let's jump right in. These funds all employ a covered call strategy to collect premium for options positions sold while owning securities in the same underlying instrument. To implement their covered call investment strategy, these funds use synthetic long positions as their collateral instead of traditional asset purchases. These synthetic positions replicate the performance of the underlying indices, such as the Innovation 100, S&P 500, or Russell 2000, while requiring less capital compared to directly holding the physical stocks. There are many ways to create a synthetic long position using options. These funds use deep in the money call options as their method. This means purchasing call options with distant expirations that carry a high delta. Delta is the measure of how much the option price is expected to change with every $1 move in the underlying. A high delta, say 90, means that the option price should move 90 cents for each dollar of movement. In this case, the in-the-money options will closely track the performance of the underlying index. The use of synthetic long positions adds a level of capital efficiency. If I wanted to purchase 1,000 shares of SPY at today's price of roughly $597, it would cost $597,000 in total. If I purchased 10 contracts of an option with 11 months until expiration, with a delta of 95, the 290 call, it would cost approximately $318 or $318,000, a $279,000 cash savings. Of course, with all markets, there is no free lunch. There is a cost associated with this trade-off. If you look at the intrinsic value of the option versus its cost, you will see a premium being paid. In this example, the premium is $11 or $11,000. To offset this cost, each of these funds also holds positions in the First American Government Obligations Fund, symbol FAAXX, which seeks to provide current income by purchasing U.S. government securities directly and indirectly. This investment provides the fund additional income. Now, let's look at how these funds can earn such high yields. To earn distributable income weekly, these funds sell 0DTE options, meaning that the options sold will expire that same day. The prospectus for each fund notes that the 0DTE options sold are out of the money or above the current price. While the exact distance from current prices is not disclosed, it is noted that it will be based on current market conditions. As the underlying security moves, the owned long-dated options will also move. If the underlying index declines, so will the owned options. Similarly, an upward move will increase the value of the underlying owned options. At the end of each day, the sold 0DTE options will either expire worthless or be liquidated at the closing price less the strike price. A loss on underlying index may be somewhat mitigated by the collection of option premium. A gain on the underlying may result in a loss on the short position, although gains over the sold strike price will be offset by commensurate gains in the owned options. Here's how this will work. Sticking with our SPY example, we purchased 10 contracts with a 290 strike price. After the market opens, we could sell the $599 call expiring today. We receive $1.15 or $1,150 in premium. If the underlying index closes at 598.50, the call option expires worthless, resulting in a $1,150 gain, plus a gain in the owned option of $1.50. If the index closes at $600, the short option will be closed at $1, resulting in a gain of 15 cents on the 0DTE option, but an increase in the owned option's value of $3. In the case where the index closes down, say 595, the 0DTE option expires worthless, and the long options lose $2, offset partially by the $1.15 in premium collected. While $1,150 may not seem like much compared to a $318,000 investment, let's do the math. $1,150 over 5 trading days is $5,750, which equates to 1.8% for the week. Over the course of the year, this calculation equates to 94% or $299,000. Of course, this is an oversimplification as conditions are constantly changing as market volatility and sentiment move, but you can see quickly how this has real potential. Hi there! If you've managed to stick with me this far and found this material valuable, please like the video and subscribe to the channel. It's a big help. Okay, now let's talk about some of the risks on these strategies. Like all covered call writing strategies, the zero DTE strategy carries similar risks. However, these ETFs have an interesting twist, which I think is a real advantage. With a traditional covered call strategy, such as with JEPQ, the options sold have an expiration of 30 days or more. This provides a higher premium collected and allows potentially more room for appreciation, as you can still collect meaningful premium at higher strike prices. This carries risk as underlying indices or equities can have large up moves over 30 days, which can quickly move higher than the call strike price sold, meaning that the fund will miss out on the capital appreciation above their strike price. Moves to the downside are unlimited with these strategies, although mitigated partially by the option premium collected. With the zero DTE securities, these risks are the same, except for a few key components. They do have the risk of capping upside gains at the sold strike price. But since these funds enter the short call trades at the beginning of the trading day and expiring that day, the risk of being outrun by large up moves is limited to only intraday movements. This means that upside is only capped that day, and the next day starts again. These zero-day funds also have the downside risk associated with their underlying. Although relative to the funds that sell higher premium, longer-dated options, these funds have the disadvantage of only collecting the smaller daily premium, which will not provide as much protection in down markets. Though this has a silver lining, larger down moves are usually accompanied with higher volatility, which means these funds can take advantage of these higher premiums each day. As we know, higher volatility equals higher option prices. But here's the twist I really like. Since the sold options expire at the end of the trading day, these funds are subject to overnight market risk. While this might not sound like a benefit, it's important to look at the statistics. Reviewing the performance of SPY over the past 30 years, the market opens up relative to the prior close approximately 55% of the time, and down only 43% of the time. This means that a fund such as XDTE will get the benefit of an opening up move more often than not, and could help the fund keep up in a bull market. Let's take a closer look at the specifics of these three ETFs: QDTE, XDTE, and RDTE. QDTE focuses on the Innovation 100 Index, providing exposure to innovative, high-growth companies. This focus offers higher growth potential during market rallies, but may also introduce more volatility. The Innovation 100 Index is a globally recognized index that tracks the performance of the largest non-financial companies listed on the Nasdaq stock market. The components of this index are weighted based on market capitalization and IT-heavy with top holdings such as Apple, Microsoft, and Nvidia. XDTE tracks the S&P 500 index, offering a more diversified approach, with exposure to a broader range of large-cap U.S. companies. Although this index is also tech-heavy with Apple, Microsoft, Nvidia, Amazon, Google, Meta, and Tesla in the top positions representing over 33% of the index. XDTE does represent more diversification compared to QDTE, which will typically result in lower volatility. RDTE uses the Russell 2000 Index. This includes 2,000 diverse companies. The top 10 holdings represent only 3.83% of the portfolio, with the largest holding only 0.55%. This underlying index can be more sensitive to factors such as interest rates and has historically had more volatility. These are really the new kids on the block, but let's see how they have performed so far. QDTE launched on March 7, 2024, and paid a total of $11.60 per share in 2024, or about 22 cents per share weekly. With a recent closing price of $39.41, this would equate to a 29% dividend annual return. Looking at the total returns for 2024 considering both dividends and stock price changes, the total return was 11.3%. By comparison, the QQQ, Invesco's NASDAQ 100 fund, had a total return of 15.29% over the same period. Similarly, XDTE also launched on March 7, 2024. It paid a total of $10.73 per share in 2024, with an average of 25 cents weekly. With its recent price of $49.39, this would equate to a dividend return of 26% annually. From inception to year-end, the total return for this fund was 16%. Over the same period, SPY, the SPDRS, and P500 ETF Trust returned 15.2%. RDTE began very recently on September 10, 2024, but has distributed $5.60, averaging 34 cents, as of January 17, 2025. This is a 13.3% dividend yield thus far, with a total return is 11.3%. The return for the Russell 2000 over that same time frame was 8.5%. Well, there you go. Today, we've explored three powerful ETFs that demonstrate the potential to earn extraordinary yields. These three ETFs, while they are still in the early stages with less than 12 months of performance, seem well positioned to excel with weekly dividends. I like these for two primary reasons. First, because they will be able to capitalize daily on increases in volatility, which means higher premiums. And second, I like the opportunity to participate in upward movements that occur overnight. I believe this could help in strong bull markets. These high-yielding ETFs are certainly worthy of consideration for investors seeking passive income and willing to take the risk of a new fund. I hope you found this material valuable. Let me know what you think. If you have any questions or if you know of any other securities that I should have considered, please leave a comment below. Thank you for watching. Until next time, good luck out there.